You've got your financial retirement plan in place and you're ready to hand in your 2 weeks notice. But what are your health insurance options if you want to retire early? So today we're going to talk about 4 health insurance options for those wishing to retire early. Now, if we miss any, please let us know in the comments below. And of course, if you have any questions, you can reach us in the comments or at the number on the screen. We are licensed health insurance brokers, and of course, there is no charge for our services. And please make sure to like and subscribe to stay up to date. So let's talk about those 4 options. If you're leaving a job with group health insurance, then you may want to look into COBRA. Now let me stop and say this is definitely not our #1 recommendation, but it's at least something that we should discuss. And of course, there will be better options later in the video. COBRA is really meant as a stopgap between better insurance options. And there are pros and cons and times that you may wish to utilize it. Now, COBRA will allow you to keep your exact same group health coverage. And this is great if you have specific medical needs and perhaps you're seeing specialists or hospitals who only accept limited health insurance plans. In this case, you might want to consider it, at least temporarily. Unfortunately, COBRA can be extremely expensive. Under the ACA, employers with at least 50 full-time employees must offer affordable health insurance, and they must contribute at least 50% of the monthly premiums. So with COBRA, you'd be responsible not only for your monthly premium that you're used to paying, but also your employer's portion as well, and possibly a 2% administrative fee. So you can expect that your monthly premiums will double at the very least. So COBRA is expensive. However, if you've already met your deductible or even your out-of-pocket maximum for the year and you're expecting some major medical procedures or you're in need of major medical care, then it might be in your best interest to keep your COBRA coverage at least temporarily. Make sure you run those numbers and compare, because especially if you've already met that out-of-pocket maximum, then you wouldn't have any remaining medical bills for the year. Your insurance company would take it on. You'd only be responsible for your monthly premium. So there are some instances in which COBRA can be helpful, but remember, it really is meant as a stopgap. Then there is marketplace insurance. Now for marketplace plans, there is no medical underwriting, which means you can't be denied or charged more based on your health. And we'll get more into that later in the video. Remember that when you leave your job, once you lose your health insurance coverage, you would enter into a special enrollment period for a marketplace plan. Marketplace plans must offer at least the 10 essential benefits, and then you can purchase additional coverage for things like dental and vision rather inexpensively if they're not already offered by your plan. And of course, even though those 10 essential benefits are required, many plans offer additional benefits to entice beneficiaries. The really important thing to discuss when it comes to marketplace plans is eligibility for those premium tax credits. Eligibility for a premium tax credit is determined by your household size and your income, but they are not taking your savings or assets or anything like that into consideration. So if you're someone who's looking to retire early and possibly live off of your savings or assets, and now you have a significantly lower income, it's likely that you'll be eligible for a rather large premium tax credit. If your income is low enough, you may even qualify for a $0 monthly premium plan. Now, if you're not eligible for a premium tax credit, then those marketplace plans can be a little bit pricey. They can also be a little bit limiting because it's very hard to find a PPO plan which will give you maximum flexibility, especially if you're looking to travel. Generally speaking, we're only going to find HMOs and EPOs on the marketplace. So if you are someone who is ineligible for a premium tax credit, or you're someone who needs a PPO because perhaps you're interested in traveling extensively in your early retirement, you may want to consider a private insurance plan. Because like I said, if you're ineligible for a premium tax credit, then really it might be comparable. So let's really discuss short-term medical plans, which are a specific type of private insurance. Short-term medical plans are so named because they are renewable for up to a short term, generally speaking up to 3 years in most states. And of course, there are pros and cons. So with a short-term medical plan, you'll have access to nationwide PPO coverage, and that is almost impossible to find on the marketplace. You'll have access to HMOs and sometimes EPOs, although not always. Now, short-term medical plans, though, will have medical underwriting. That means you could be charged more or denied based on a pre-existing condition. And if you do have a pre-existing condition, it may not be covered at all, but it certainly won't be covered in the first year of a multi-year plan. Now, that's not the case with the Marketplace plan. There is no medical underwriting, which means you cannot be denied or charged more based on your health, and pre-existing conditions are, of course, covered. Short-term medical plans don't offer those 10 essential benefits, so something like pregnancy is not covered by a short-term medical plan. And of course, pregnancy would be considered one of the 10 essential benefits covered. Now, because there are no 10 essential benefits and there is medical underwriting, you may be able to have access to a very low monthly premium, especially if you're somebody younger in good health. However, on the Marketplace, because there is no medical underwriting, you're not going to qualify for a lower rate based on your health. However, you may qualify for a premium tax credit based on your income. Something else that I do want to mention, short-term medical plans actually aren't available in all states, and even if they are, they may not be ideal for your family if you have young children. And finally, I would like to talk about a more creative solution to healthcare, which would be combining something like a direct primary care plan with a more limited healthcare plan. Now, direct primary care, or DPC, isn't actually health insurance. Basically, it's an agreement between you and your PCP, which is your primary care physician. So you'll enter into this agreement with your physician. The amount that you pay on a monthly basis is determined by your physician. And like insurance, you will pay that amount monthly, but it is not a monthly premium in the sense that it is not insurance. So this will cover whatever is outlined in the terms of your quote-unquote plan with your physician. It'll usually include as many physicals or visits whenever you need them, and also visits not only in person, but usually on the phone or even via text. Now, of course, not all physicians offer this, so you would need to find a PCP that does. And if you need to see a specialist or get a prescription filled, or if you have a more extensive medical need that isn't handled simply by your PCP alone, then that plan wouldn't really cover it. For this reason, people who enter into these type of agreements are encouraged to enroll in a more bare bones health insurance plan as well, something to cover larger medical needs that may pop up unexpectedly, something like a catastrophic coverage plan. Catastrophic coverage plans are really there to help protect you from something catastrophic. They're not there for those more minor and basic needs. So usually you'll have a pretty darn low monthly premium, a high deductible, and you'll have an out-of-pocket maximum. And that really is the most important part here. Out-of-pocket maximums are there to protect you should you incur major medical bills. So if you develop an unexpected medical concern, or if you need an expensive surgery, something like that, if you didn't have an out-of-pocket maximum, then there's really no limit as to what your yearly spending could be. An out-of-pocket maximum is there to protect you from those major medical bills. Once you hit your out-of-pocket maximum for the year, then your insurance carrier would take on the remainder of the bills for those covered in-network services for the plan's benefit year. So basically, by combining this type of agreement with a catastrophic coverage plan, you'll have your more basic needs covered and have some type of protection in place should something expensive and unexpected occur. You could, of course, also look into something like a critical illness plan, and that will pay out a lump sum should you be diagnosed with one of a very long list of critical illnesses, something like cancer. Or you could look into a hospital indemnity plan, which works similarly. This will pay out a lump sum if you're hospitalized. So in summation, consider COBRA only under specific circumstances. Look into a Marketplace plan, especially if you're going to be living on a lower income, surviving mostly on your assets and savings. Consider a short-term medical plan, especially if you are someone with limited medical needs who may be able to take advantage of those lower monthly premiums, or someone who's ineligible for a premium tax credit, or someone who definitely wants to take advantage of the flexibility of a PPO. And finally, look into a direct primary care agreement and supplementing it with something more bare bones to protect you from major medical needs like catastrophic coverage, critical illness, or a hospital indemnity plan. If you've got some other creative solutions, let us know in the comments below. It can definitely be tricky to navigate that pre-Medicare stage of your retirement, but you don't want your health insurance to stand in the way of you retiring early. If you have any questions, please reach out to the number on the screen or in the comments below. We'll see you next time. Hey, thanks for watching. Before you go, make sure to like and subscribe as well. And make sure to check out this video if you're looking to retire early to learn a little bit more.